What has happened recently is not just another economic headline. It's the starting gun for a race you didn't know you were running, and you're already behind if all you have is savings. The U.S. Federal Reserve, the group of people in charge of deciding how many dollars get printed, has just made a decision that changes the map completely. They pressed the button to make borrowing cheaper. It's as if, from one day to the next, the interest you're charged on a mortgage, a car loan, or a credit card started to fall. And while that may sound good, it has brutal consequences for savers and very favorable ones for investors. The Fed meets 5 or 6 times a year to decide the price of money, what they technically call the federal funds rate. This isn't an abstract concept. Let's explain it. Banks lend money to each other constantly. It's a necessity of their business to square their books every day. The interest they charge for those ultra-short, overnight loans is what the Fed controls. That rate is the base of everything, the fundamental cost of money in the whole system. If that cost falls for banks, they can afford to lend to you for mortgages, car loans, etc. at lower rates. If that cost rises, all credit in the economy becomes more expensive. Well, they've just opened the tap. The committee decided to reduce the target range for federal funds by 0.25%, leaving rates around 4.25%. This move isn't a technical tweak. It's a statement of intent. Jerome Powell, the Fed's chair, came out to explain it in a press conference that markets were scrutinizing. He basically confirmed that this change of pace is a defensive maneuver. They're not on offense. They're reacting to signs that the economy is weakening. Why are they doing it now? The Fed has what's called a dual mandate, like a juggler trying to keep 2 plates spinning at once. One plate is inflation, keeping prices from skyrocketing so your money doesn't lose value. The other is employment, so that everyone who wants to work can. In recent years, the obsession has been the inflation plate. They made money relentlessly more expensive to slow price increases. But now it looks like they've glanced at the other plate and seen that the employment plate is starting to wobble dangerously, and they've become alarmed that the economy might cool so much that companies stop hiring and start firing, kicking off a destructive spiral. The official figures give them reason to worry. The latest jobs report from the U.S. Bureau of Labor Statistics was a bucket of cold water. It showed nearly zero job creation, an unmistakable sign the economic engine is losing steam. Total non-farm payroll employment changed little in August, up 22,000, and the unemployment rate stood at 4.3%. When the market, a hypersensitive beast that tries to predict the future, sees the Fed spooked about jobs, it interprets the message instantly. It doesn't see a one-off cut, it sees the first of several. To measure this expectation, we use the FedWatch tool, which calculates the probabilities big investors assign to future moves. It's like reading their minds, and their reaction was wild. They take it for granted that this is just the beginning of a new era of cheap money. After the announcement, the implied probability of 2 cuts this year, one on October 29th and another on December 10th, jumped above 80%. The market sees the Fed's fear of a recession and surges ahead, setting off a domino effect that reaches your wallet. First, the Fed lowers its rate, the factory price of money. Immediately, the second domino falls, the one that really matters to you, the so-called prime rate. Forget the name, remember the idea. It's the base rate banks use to calculate interest on almost all their loans. Within hours of the announcement, big banks made their move. For example, Wells Fargo announced it was reducing the prime rate to 7.25%. That drop filters straight into your pocket, for better and for worse. Mortgage costs, for instance, are closely tied to these decisions. This cut confirms the downward trend, a relief for anyone with a variable rate mortgage or planning to buy. The average 30-year fixed mortgage rate was 6.35% as of September 11th, but here comes the flip side, the silent blow to savers. If you have money in a savings account, the yield your bank pays is directly linked to official rates. If the Fed cuts, your bank will pay you less for your money. A very simple example. If you have $10,000 in an account paying 1% per year, you earn $100 annually. If, because of this cut, your account's rate falls to 0.75%, you'll now earn only $75. You just lost $25 a year without doing anything. It may not seem like much, but imagine you're a retiree with $200,000 saved. Your annual interest income just fell by $500. That's less money for groceries, bills, or emergencies. Your money suddenly works less for you. This is the first direct and invisible impact of the decision that has just redrawn the financial map. And it's only the beginning of the problem for those who don't invest. The real consequence, the one nobody tells you on the news, is that a silent war has just been unleashed, a brutal transfer of wealth from savers to investors. Now let's see who wins, who loses, and how this shows up on your grocery bill. The first thing to understand is that when the Fed cuts rates, it is deliberately penalizing savers. It's not a side effect, it's the objective. The Fed fears deflation, a general drop in prices, more than a vampire fears garlic. Deflation is the apocalypse for the modern economy because it paralyzes spending. Nobody buys today if everything will be cheaper tomorrow. To avoid it at all costs, they need there to always be a little inflation. Your money losing value in a bank account is, to them, a necessary casualty in that war. The problem is that inflation isn't a little. It's still a fire that isn't out. Over the last 12 months, the All Items Index rose 2.9%. This creates a deadly trap for your savings. The bank pays you a pittance while prices rise nearly 3% a year. You're losing money every day that passes. What's incredible is that the Fed itself knows inflation isn't under control. To understand their decisions, you need to know they focus mainly on core inflation, price increases excluding food and energy, which are very volatile. It's their way of seeing the underlying fire of inflation, the one that's hardest to extinguish. And their own internal projections admit that fire isn't out. Their forecasts confirm that core inflation is expected at 3.1% for all of 2025. And this isn't just a future forecast. It's happening right now. The latest reading of that underlying inflation the Fed likes so much, the one that excludes food and energy, shows the problem is serious. That indicator rose 0.3% in the last month. 0.3% in just 1 month seems small, but if it continues at that pace, it means prices are rising at an annual rate of more than 3.5%. That's a big bite out of your paycheck. So where does all that money fleeing bank accounts go? In search of yield. Think of it like musical chairs. The Fed has removed almost all the safe chairs that paid anything. Now everyone is running, desperately trying to sit in the few chairs that still offer returns, like the stock market. The music speeds up and the price to sit skyrockets. This is a melt-up. That's why we're seeing the stock market throw a party. The S&P 500's return over the past month was more than 2%, but the party isn't the same for everyone. Money isn't flowing to solid, boring companies. It's going to what's trendy, mainly technology. The telecommunications sector posted an incredible 11.2% just in August. This market party creates a dangerous wealth effect. Those who hold stocks feel richer and spend more, and the data shows they are. Retail sales in August 2025 were $732 billion, up 0.6% from the previous month. That extra spending pushes prices even higher, and here mass psychology kicks in. Fear of missing out, or FOMO. When your neighbor, who knows nothing about finance, tells you they're getting rich, panic sets in. You see your money rotting while others seem to print cash, and that pressure pushes you to buy, often at the worst possible moment, when everything is already sky high. To see it clearly, let's go back to 2 cases. First, the retiree. Their interest income has collapsed, and people are living longer. Their savings have to last 30 years while earning less and less, as the cost of living keeps rising. They're trapped. Either they sell their life savings to pay the bills, or they cut expenses to the bone. It's a sentence to precariousness. Now the other side, a family with debts. Many people are suffocating under credit cards. Before giving the numbers, let's be clear. Revolving credit is the technical name for what people owe on their cards. It's the most dangerous debt and the fastest growing. That debt, the total owed on credit cards, grew at a 9.7% annual rate. While the stock portfolio neighbor buys a new car, this family is using a credit card to buy groceries. It's not luxury, it's survival. Delinquencies are already at red alert levels, showing the system is at the limit. Credit card delinquencies of more than 90 days reached 10.2%. The interest on their debt falls a bit thanks to the Fed's recent cuts. Yes, but the noose is still tight because their wages aren't keeping up with inflation. The Fed's policy leaves them in a state of extreme vulnerability even as it inflates. This is the battlefield, a paradise for investors and a trap for savers and the indebted. Some are getting rich while others are slowly drowning. Faced with this landscape, the question is, what should you do now? It's not about predicting the future, it's about having a plan. Let's look at practical steps you can take today and the scenarios that may come tomorrow. First, tactics. Depending on your situation, you need to play defense or offense. If you're a conservative saver, your enemy right now is inflation. Idle money in a checking account is money that loses value. I know what you're thinking. Why move it if nothing pays anywhere? That's the mental trap the Fed wants you to fall into. The goal now isn't to get rich, it's to avoid losing value. You have to move. The why is simple. Every dollar that doesn't earn at least the inflation rate is a dollar losing value. Look at neobanks or online banks that often offer interest-bearing accounts or short-term deposits that, even if modest, at least try to fight. We recommend laddering your maturities. Some at 3 months, some at 6, some at 12. Why do this? It gives you flexibility. If you lock it all for a year and rates suddenly rise in 6 months, your money is stuck earning a pittance. If you have a portion maturing every 3 months, you can quickly reinvest at the new, higher rates. It's a way not to get married to the current situation that if you're a worker whose paycheck isn't rising, your absolute priority is defense. Your main risk is the one the Fed itself has flagged: employment. Your best weapon is an emergency cushion of 3 to 6 months of fixed expenses. And no, this is not savings for surprises. It's a shield. Why? It buys you bargaining power and dignity. Without it, if you're laid off, you have to take the first job offered, even if you don't like it and it pays less. With that cushion, you can afford to search calmly and find something worthwhile. It gives you control and, above all, keeps you from resorting to credit cards, the fastest road to financial hell. And it's hell for a reason many people don't know. In the United States, there is no nationwide legal cap on credit card interest. There is no general national ceiling for interest rates. That's why you see cards charging 25% or 30%. It's a perfectly legal debt trap. Hence the importance of the shield that if you invest in stocks, you're in the middle of the party. The music is blasting and the temptation is to bet everything on red. That's the shortest path to disaster. Easy Fed money is inflating valuations to absurd levels. Your job now is to be the responsible adult. Make sure your money is in solid businesses that make real profits, not just promises about the future. Why? Because when the cheap money music stops, companies that are all smoke will collapse like a house of cards. Those with solid earnings will limp, but survive. Now let's look ahead. There are 3 main scenarios. First, the dream landing. This is the ideal scenario the Fed wants to sell. Rate cuts cool the economy just enough to avoid destroying jobs, and inflation gradually returns to 2% without causing a recession. For you, this would mean your variable rate mortgage keeps falling. Your grocery bill stops shocking you every month, and if you have a job, you likely keep it. It's a happy ending scenario, but also the least likely. Second, the inflation storm. This is the big danger. It happens if the Fed cut rates too soon. Why? The price-wage spiral. Inflation rises, you ask for a raise, the company hikes prices to pay it, and that creates more inflation. A premature rate cut is like pouring gasoline on that spiral. One of the earliest warning signs for this scenario is the prices firms pay to produce, known as the Producer Price Index, or PPI. Think of this as the factory's inflation. It rose 2.6% over the 12 months ending in August. If this number starts to climb, it's bad news. The reason is a simple chain reaction. If it costs factories more to produce, they will pass that bill to you at the supermarket by raising prices. That spikes the inflation you suffer and forces the Fed to reverse course and jack rates up aggressively to stop it. Those hikes choke the economy and trigger the recession they were trying to avoid. Third, the hard stop. The Fed's cuts aren't enough. People's confidence collapses. To measure it, we use the Consumer Sentiment Index, which is just a survey of thousands of households asking how they see the economy's future in their own finances. It's a thermometer of optimism or fear, and we're already seeing signs that fear is taking over. The preliminary reading of this index for September was 55.4, and it's not just fear, it's anger. People are tired of feeling like the system is playing them. One proof is the number of formal complaints filed against banks and financial institutions for problems with mortgages, surprise credit card fees, or credit report errors. In 2024, approximately 1.4 million such consumer complaints were received. When people lose confidence and also feel cheated, they stop participating in the economy. The why behind this hard stop is panic and a credit drought, a credit crunch. Banks stop lending to each other, and credit, the oil in the economy's engine, dries up. The situation for banks would also become worrisome. The number of banks on the problem list rose to 52. And all this with a government that spends like there's no tomorrow, piling up a gigantic debt that keeps growing. To keep it simple, think of this traffic light. Green light is stable employment and falling inflation. Amber light is strong employment but inflation reaccelerating. And red light is rising unemployment and plunging consumer confidence, which is where we are now. These are the data points you need to watch to know which scenario we're entering. Because in this war, information is your only defense. We hope you liked the video. If so, it would help us a lot if you left a comment. YouTube values that greatly and recommends our videos to more people. And hit the bell so you get a notification when we upload our next video. See you there.